Hello everyone, welcome back. Patrick here. In this video I want us to address some of the structural issues with the SPACs. So in the past month, you guys know this, I've not been as positive about them. In fact, I've been very critical, and some of my comments have ruffled some feathers. I'm not really sure why. I think it makes sense, but most of my arguments were about the fact that long-term SPACs are still good. I don't think that they're dead. If you buy a SPAC cheaply, and it's a solid company that has a product and revenues, and you go back to it in 5 years, well, the company will have grown and your portfolio is going to be okay. But I think it's undeniable that in the short term, right, very differently from December and January, you can't just throw a dart at the SPAC board, grab one of them, and then all of a sudden, within a few weeks, you're going to get 200%, 300%, 400% returns, like was the case before when the spac-land was different. So that's my main point. Currently in the market, and even in real life, there are other alternatives that are going to generate more capital gains than SPACs. So in this video, I want us to mostly go over this post by Ugde80. Let's read through it together. It kind of recaps a lot of what I've said over the past month, but I have to give credit to this person. He really summarized it well and articulated why the SPACs are different now than they were in September and November, October, of course, when they really crashed. But then after that, we had a really big rebound. Is it going to happen again? Possibly, but things are a little bit different. So let's go through it real quick. So current SPAC landscape, he's comparing the two periods, and he's talking about how there are plenty more new SPACs now than there were before. So we've talked about this before. In the first 3 months of the year, there has been more SPACs created and IPOing than in the entire year of 2020. That means that there's a big dilution in terms of like our attention span. One of the big benefits to the SPACs before, one of the things that attracted me to them was the fact that it was kind of like a big spotlight on one company. Let's say that there were about 20 big SPACs going on at the same time, covering different industries. So you had, let's say, LCA for gambling. You had Tattooed Chef, right, for the food industry. You had Desktop Metal for 3D printing. There was maybe one, maybe two, if you consider, let's say, Velodyne and GMHI, right? So there were maybe one or two per industry at a time. So anyone that was interested in those companies didn't have 5 or 6 choices. They were going for that one opportunity. That's why companies like ChargePoint, which is not really that good, went to $40 plus. People discovered it, liked the industry, and they were the only option. Well, now in 2021, that is different. Right now, I've shown you a graph before where for each of these industries, you have like 5 or 6 choices. I call them copycat SPACs. There are more and more of them coming out in the market and trying to ride the coattails of the previous SPACs. So we see that especially in the electric vehicle SPACs, right? They keep coming. Same for the charging stations. Now the new fad is going to be the air mobility, like, you know, the eVTOLs. So there's just too many of them. So all of the SPAC investor money is diluted through all of them. All right, so naturally more SPACs has led to more SPAC deals, obviously. Many, if you look at them on Monday morning, it's pretty funny. There's usually a couple of them. All right, so many deals are getting worse. Because the sponsor promote and incentivizes SPAC sponsors to get many deals done, the quality is going down. Some of them are garbage. I've talked about this before. I'm really not impressed with the current crop of SPACs coming out. Because there's a ton of SPACs out there, they're starting to command less negotiating power. When you have many SPAC sponsors looking at less deals, well, all of them have to overbid each other, do less due diligence. I'm going to show you a clip in a second, resulting in overpriced valuation. Pretty much, companies that have no revenues are worth billions of dollars. It makes 0 sense. Also, the universe of solid targets that are willing to go through the SPAC route may decline in the future as more and more viable targets have gone public. It's kind of like a draft in football or any other sport. The first round picks are going to be better than the third and fourth round picks, right? So in the beginning, you're going to get all the all-stars, and then after that, you're going to get the leftovers. Now, I want to play a quick clip from Barry Sternlish. You guys probably know him as one of the investors that have done a lot of SPAC deals. But listen to what he said recently on CNBC.
committed to these companies. I think they're great companies. We're fiduciaries by nature. I've done that for 30 years in Starwood Capital Group. So, our reputation is really important to me and screening these deals. I wouldn't say that's true of all SPAC sponsors, though. You're exactly right. I mean, this is a free option for people, and you can't compete against stupidity. We lost several companies the weeks before. One in particular where we wanted to do 60 days due diligence, and the competitor said they do 3 days due diligence. I can't compete.
All right, so 60 days due diligence, what any smart investor should do. I don't know about 60 days, but you guys get my point. Remember, like, we really rely on these SPAC sponsors to do due diligence for us, right? Investigate the company, call the suppliers, call the customers, make sure it's a legit company. And what Barry Sternlish says now is that since there are so many SPACs out there, well, they're going to be competing on giving the company the most attractive terms, including, this is like buying a house sight unseen, right? So if the house has foundation issues, well, you don't see them because you didn't do any inspection, right? They are that desperate to find deals, and who's going to suffer from that? It is us, the small retail investors, who are relying on these guys. So that's why we have the Lordstowns right now, right? Fake orders and all of that. We've had Nikola before. Clover Health's a little bit different, right? It was more of a friendly deal between Chamath and the guy. But overall, that's why we are going to see a propensity to get more and more deals that are not really vetted as well as they should be. Next item on his list is that right now the short sellers are attacking the SPACs. I've seen Carson Block from Muddy Waters confirm this recently, and you see it on TV. Short sellers are betting more against SPACs. It's seen as an easy target for them and easy money. So again, I'll bring you back to the charge point chart, which, I mean, when you look at this, you can see, hey, these guys are probably reaping the benefits of the small investors' greed. So this company went up to $49, right? And that was completely outrageous. You guys see how much competition there is in that industry. Well, right now, the share price is down to the low 20s, and small retail investors like us just cannot handle this type of price action. People can't sustain 150% drop like this, and then the people are going to be selling at a loss. And this is all to the benefit of the short sellers. So that's just the way it's been, right? They're seen as easy targets. Growth speculative stocks have been selling off. I mean, we can't really control what's happening in the overall market, the inflation, the 10-year bond, all of that. We can't control that. So when the market is in a panic, what they do is they sell off the riskier assets and they have that flight to safety. Now you're going to say, well, the $10 SPACs are very safe. Yeah, they are, but most of them didn't start at $10. They were at $18. They were at $25, $30. Now they're at 10 because they dropped so much, right? So that's why even the tech stocks, which didn't do very much in the past couple of months, now at least they're sustaining because people want to go invest in Facebook and Microsoft and Amazon when the market is unstable. So they've lost a little bit of value, but almost nothing compared to the SPACs, which have dropped 50%. We'll go over the rest fairly quickly, but he goes into the mentality of the small retail SPAC investor like us, and we're all facing those challenges, including myself. I fight this every day, and I've learned over many years some of these lessons. So we're prone to volatile emotions, right? We often capitulate on some stocks. We figure, hey, it's been dropping, I just can't hold it anymore. Or people buy the dip, and then it keeps dipping and dipping and dipping, and then they're like, well, now I'm stuck with it. Lack of profit taking. You have CCIV that went to $50, $60. I told many people, take some profits. And there are a lot of people that just left it all ride, and now the stock is in the 20s, as you guys know. Buy high, sell low. That's what we talked about earlier. We were spoiled by last year, completely aberrant year of gains and excessive pumping of stocks across the board, and believe that will continue indefinitely. I mean, who didn't think in January that we had to go all in on these SPACs? I mean, there was no better asset class, in my opinion, in the market than SPACs at the time. And a lot of people went and started to use margin, including myself. I'm never going to use a lot of margin, but I went to 10%, 20% on some of these positions, right? And when the market started to trade sideways and then go down, a lot of people got wiped out from it. A lot of people were going into options on these SPACs, even though they're already speculative, right? And then you add on top of that the speculation that is options. I mean, we were just very greedy and expected that it would just keep going higher and higher. Set stop losses that are easily bust through, kind of disagree on this one. You guys know that I'm a big proponent of stop losses and it saved me a ton of money over the years. Sometimes lack patience, of course. Sometimes do not understand the companies they're invested in. This, I'm going to blame the SPAC sponsors a little bit. I'm going to show you an example in a minute. Sometimes buy SPACs after doing only 1 minute of research. Again, same thing. You know, there's the greed factor, but there's also the fact that the sponsors are marketing it in a certain way to kind of deceive the small retail investors. More SPAC traders and flippers than long-term investors. We all want to pretend that we're long-term investors, but when the SPACs were going up 200%, 300%, everyone liked that short-term profits, right? So a lot of us wanted to sell them and then go to the next SPAC. I mean, it's just the nature of things. Think valuations do not matter. Not going to comment on this one. It's all about speculation with SPACs. Some gurus have told me. What happened then? We're recently screwed over by Michael Klein, the lucid one. Again, I don't really agree with this one. The Bloomberg articles were very accurate in their projections. All right, guys, and the rest of the article, he talks about its different strategies now that the SPACs are changed. I'm going to link it in the description if you don't want to go read the full thing and give him your comments. But before you leave, I want to tell you guys how these companies now, the sponsors are a little bit deceptive in their marketing. So I'm not saying that they're lying. It's not fraud or anything unless it's like Lordstown. But in general, they're really embellishing them and trying to lure in more retail investors that are not as experienced and don't do a lot of due diligence. So the only way to contact me is either in the comments here or my email address, andwithmorellc@gmail.com. So I'm never going to be in the comments and tell you about WhatsApp or tell you to send me Bitcoin and all of that. So if you see this, it's someone impersonating me, just please report it. So with that said, the person sent me an email and asked me about Berkshire Grey. All right, this is going to be merging with RAAC. All right, so they're going to transform their warehouse operations. They're doing AI, and they're going to be automating some of the tasks in a warehouse. So this is very good. I mean, I'm going to tell you guys, some of you probably don't know, I've worked in a Target distribution center for over a year. So I picked items from shelves, I unloaded trucks, I drove a forklift, a reach truck. I've done a lot in the warehouse. So I know a little bit about how things work, right? And I can tell you that this is clearly a product that is going to work and is in demand and they need, right? But it's when you go into like the details of the deal that you're like, they're really embellishing things. So they list some of their customers. You have Walmart, Target, FedEx, and TJX. You're thinking like, as a small investor, this is very, very impressive, right? This validates a lot of what the company is about. Walmart and Target are some of the top retailers in the country. Then you go here and you see $11 billion in capex for Walmart, 3,979 distribution centers. Target, $3 billion, 1,910 distribution centers. And then they go on and on about how big the market is and everything. Well, the thing is that this is not true, right? So 1,910 distribution centers, they say includes the stores. Now, are the stores going to need millions of dollars worth of robots to automate all of the tasks? It's not going to happen. They're not going to do that. Target has a little over 40 distribution centers, right? So that's where all the merchandise goes and then it gets distributed to the different stores. That is where this company is going to provide the products, the automation and everything. So the market is not 1,910, right? That sounds, hey, this is a huge opportunity. No, for Target, which is one of the biggest, it is about 45 different warehouses that can be automated like these. So the market is much smaller than they make you think it is. Then if you go here, $280 billion total addressable market and growth driven by multifaceted tailwinds. So the real definition of total addressable market is if you captured 100% of the market share how much money would you make, right? So total addressable market, term that is typically used to reference the revenue opportunity. All right, so this is not what the company is saying here. They're saying that 230 plus billion is total annual warehouse labor spend. So that's a reason to use their product to replace the actual warehouse labor, like the people that are picking in the warehouse and doing the distribution. This is not the size of the market. So if you're just observing this at a glance and you're reading through it and 280 billion TAM, the company is growing, you're like, wow, this is a great opportunity. They have so much room to grow. It's not really the case, right? And then if you look at this, this is their projected gross profit and adjusted EBITDA development. You can see the company is going to start making revenue profits potentially in 2024. And then in 2025, they would generate 232 million in net cash flow. Now, if they can do that based on their very, very high projections, that would be great. But if you compare it with the 5,000 other companies in the New York Stock Exchange and the NASDAQ, do you really feel like this is a great risk versus reward, considering the fact that for Target, there's about 40 different distribution centers. Walmart, I'm not sure what the exact number is, but over time, as they fulfill some of these, yes, they're going to generate a lot of revenues, but the market is shrinking over time, right? Who are they going to go with after that? They're going to go with Asian companies. They're going to go with second tier retailers in the United States, which are smaller, are going to need less automation and everything, right? Unless they can deploy their technology to other industries, but they don't really talk about it in this presentation. So this is all to say that, right, if you compare this company with others in the market, it might do well. I'm not saying don't invest in this company, right? But the thing is that it doesn't really compare favorably with other opportunities in the market. I mean, I can go buy something from China, double my money by selling it on Amazon right now. So what is the benefit to investing in this company that is very speculative compared to these other opportunities? And that's what I want you guys to think about, right? So when I talk about how the SPACs right now are not good short-term plays, it is compared to their other alternatives. It doesn't matter if the stock is at $10 and it's safe when you can go do other things that are more profitable. I can sell options and make more money than someone holding a SPAC that has no momentum at 10% for the short term. Now, if we're talking about long term, that's totally different. There are still many SPACs that I like, and I've made a list before, right? I talk about them all the time. I bought many more a few weeks ago when they were crashing. So guys, I hope you learned something in this video. I know it's not super positive right now with the SPACs, but I hope you learned a little bit about my thinking. I hope you agree, but let me know in the comments. I really don't mind with people that disagree with me, but just like, don't say something that I never said. I never said go sell all of your SPACs at $10 to go buy something at the peak. You guys know I'm all about buying low and selling high, not the opposite. So let me know what you think. I'll see you guys in the next video. I'm going to be reviewing Momentous tomorrow. Thank you.